All right, Bitcoin is down to $65,000 yet again, so let's zoom out and actually try to understand what's happening here. Right now, believe it or not, Bitcoin is trading with software stocks. Yes, and I do realize that it is customary for Bitcoin to trade like the QQQ, but digging into the data right here, it's telling a very interesting story. The data is showing an elevated correlation, an elevated beta, and elevated volatility clustering. What does that mean in plain English? It means that right now, while the market is severely discounting software stocks because now AI is helping you build apps with the click of a button, the market is treating Bitcoin like it's a high-growth software stock that's also getting repriced in an AI disruption cycle. So I'm digging into the numbers this morning and I realized that's really fascinating because software is a claim on future cash flows, just like traditional operating businesses. It still lives and dies by margins, moats, switching costs, and competitive durability. And then when AI is accelerating the feature commoditization of software, well, obviously the software multiples are compressing. And to me, that story makes a lot of sense inside of that asset class, but Bitcoin operates on a completely different axis, obviously. Because the orange-pilled amongst us, we know that Bitcoin doesn't have a product roadmap. It doesn't have a CEO or a margin compression risk. There's no feature parity problem happening with Bitcoin. Its value driver is monetary credibility, fixed issuance, settlement finality, and global collateral utility. So when you see Bitcoin trading with the IGV, that means what you're witnessing is a macro liquidity regime overpowering the asset identity of Bitcoin. In risk-off environments, we know that funds reduce exposure, they trim volatility, they cut their leverage, they sell what trades deep and fast, and Bitcoin fits that profile perfectly because Bitcoin still is misunderstood. And that creates mechanical selling pressure of the asset. The price starts moving with other high vol assets, correlations spike, beta jumps, and when correlations jump into the top few percent of historical readings, that is a clue. It is telling us something, and it's telling us something that the fundamentals aren't changing. There is just position unwinding because markets often compress everything into a single risk bucket during stress. We see that with the volatility in gold and silver right now. Gold trades like equities, and if the sovereign debt crisis gets worse, the bonds are going to trade like equities. Bitcoin is trading like it's software in an AI disruption. It is a temporary convergence that is driven by flows, but not by essence. And what makes this powerful is that this misclassification creates something that is called a mispricing. Because if an asset with monetary scarcity dynamics, it's being priced using a high duration growth stock lens, the discount rate is being applied incorrectly. The risk model is flat out wrong, and the narrative bucket that it's been put into from the markets, that is wrong as well. And historically, when correlation spikes are driven by these liquidity events rather than structural changes, that means a mean reversion follows. Assets return to being priced by their own fundamentals, not by this nonsense risk narrative. So what we're looking at right now isn't necessarily software weakness infecting Bitcoin. It is liquidity stress temporarily distorting Bitcoin's identity. And when identity distortion clears, that means that the repricing tends to be pretty violent. Now, if you look at Bitcoin's volatility on the longer term, if you look at a rolling volatility on a longer duration than a rolling 30-day or 60-day, Bitcoin's actually the least volatile that it's ever been as an asset. But looking in over to the past few months, when we zoom in here, Bitcoin's 30-day and 90-day correlation with the software ETF IGV, it has surged into extreme territory. The 90-day correlation recently pushed into the 96th percentile of all readings since 2020. That means that only a tiny fraction of historical periods show Bitcoin moving this tightly with software stocks. And have you seen all the OpenClaw ClaudeBot news? This is why why the software stocks are getting killed, because Claude Opus 4.6, ChatGPT Codex 5.3, all of these models are just annihilating software as a service. So when correlations move into the top few percent of their historical range, this isn't background noise, this is a regime shift happening. At the same time, the regression beta has jumped. Over longer horizons, Bitcoin's sensitivity to software has been materially lower. Recently, the beta has climbed to around 1.2. So in practical terms, the market is pricing Bitcoin as if it were a high-duration growth equity with amplified sensitivity to software flows. And that is a measurable deviation in the longer-run behavior of Bitcoin as an asset. So I want you to think about what that might imply here. Because software, it's getting repriced because expectations about the future earnings change, and then the competitive landscape start to shift because of that. So the discount rates move, the AI narratives, they compress the multiples in the stocks, and that mechanism absolutely might make sense for software as a service. But Bitcoin doesn't have earnings estimates to cut. There is no guidance to revise. There is no margin to compress. So when the statistical relationship tightens this aggressively, the more plausible explanation is macro positioning. The funds are de-risking. The systematic strategies are reducing exposure. Volatility targeting models are cutting gross. Everything that might live in the high vol risk asset category bucket, they're all getting sold together. The correlation spikes, these are often evidence of liquidity events that are overwhelming asset-specific fundamentals. This environment that we're in is extremely statistically rare, and rarity in cross-asset correlation marks stress regimes rather than permanent structural changes, and this is where mispricing show up. Right now, it's undeniable that the data is showing that Bitcoin is being temporarily absorbed into a software risk regime, and that absorption is the distortion, and distortions create opportunity for the Bitcoin bulls. Okay, now let's talk about volatility and drawdowns, because this is where the macro mechanics really start to show themselves. Over the past 90 days, Bitcoin has experienced a drawdown approaching 50% from the local highs. We know that it did touch that 50% mark briefly, and we are still pretty close to there right now. And what's happened in this drawdown, we have seen the market repricing Bitcoin as if it's carrying almost 2 times the software sensitivity of its longer run behavior. This 75% beta expansion in under 3 months is signaling forced selling, not some fundamental re-rating of the value drivers behind Bitcoin. Because Bitcoin's economic model is closer to a monetary base asset, it is a digital commodity. It's not some growth equity. They're not even close to the same thing. Its sensitivity over long horizons has been historically aligned with liquidity expansion, currency debasement expectations, and adoption curves, not software as a service product cycles. So when the regime really shifts from liquidity contraction to stabilization or expansion, that's why all eyes are on the Federal Reserve chairman that's coming in. Kevin Warsh, whether he's dovish, whether he's hawkish, whether he's going to cut rates 2% really quickly. Right now, it seems like the entire Bitcoin investor community is just waiting in the wings for a different regime, a different liquidity environment, so we can see some positive moves actually start to happen, because this type of mispricing is not normal, and it tells us that mean reversion is probably nearby. For Bitcoin, the fundamental drivers are adoption, institutional balance sheet allocation, the sovereign interest of Bitcoin, all of the ETF flows, long-term monetary credibility. None of those variables are changed simply because software multiples compressed. So this setup really is asymmetric in my humble opinion, because you have an asset that is being priced with an inflated risk coefficient relative to its longer run behavior. You have a category error in the valuation framework, and you have statistical evidence that this regime is historically rare. And when rarity meets misclassification, you often get opportunity, and that is why this moment matters. So right now, Bitcoin's shorter-term beta to software has expanded well beyond its longer-run relationship. That expansion really does imply that the market is applying a higher risk coefficient than history has supported. If that coefficient simply reverts toward its multi-year average, price sensitivity of Bitcoin will shift materially even with zero change in Bitcoin's fundamentals. And that is powerful because mean reversion and correlation and beta does not require some bullish narrative shift. It only requires the liquidity regime to stabilize. Because when there is less forced selling, it starts to subside and the systematic de-risking just slows down. That means that Bitcoin no longer needs to trade like it is a software company with a multiple. It can just trade like it's scarce digital collateral again. Markets obviously tend to overshoot during stress and undershoot during calm. Today's data suggests overshoot. If Bitcoin were fundamentally impaired, we would expect structural adoption metrics, issuance mechanics, or network integrity to change. But none of that has happened, obviously. In fact, Bitcoin's fundamentals are stronger than ever. What has changed in the market is the cross-asset positioning behavior, and that difference is the entire thesis here. You're getting a commodity, a digital commodity, a monetary asset. It is being temporarily valued through the lens of equity duration risk, and the statistical evidence shows you that this relationship is historically extreme. You are just looking at a distortion, and distortion over time resolves, and that resolution is where the repricing occurs. If you look at the relative strength index, Bitcoin is at its worst spot since the crypto winter in 2022. It's telling you that it's more oversold. It's telling you that the asset is more oversold than any time over the past 4 years, and it looks oversold when you look at the Bitcoin even broader crypto market fear and greed index. It is at nearly an all-time low. Even with Bitcoin not fundamentally impaired at all, tick-tock, next block, the blockchain keeps going. The asset still remains structurally sound, yet this mispricing could not be more obvious. And if you want to be positioned in Bitcoin safely, securely, and strategically, Swan Private is for you because Swan Private helps high net worth families, family offices, and just individuals be positioned before the greatest wealth transfer in the history of humanity into Bitcoin happens. And obviously you want to be positioned before the shift occurs. Visit swan.com/no-second-best to learn more. My name is Adam Livingston. I am the Bitcoin Wizard. If you enjoyed this content, please like this video and subscribe to Swan, where we bring you the daily Bitcoin insight with more energy than anybody. Have a terrific day. Do not party too hard. Class dismissed.